Hello and welcome to Press TV News Analysis. I'm Kaveh Taqwi. The figures are astounding when it comes to the total amount pumped into the U.S. economy since the financial crisis hit. But 3 years on and now entering the fourth year, the situation still looks grim for the United States, with rescued banks facing bankruptcy again, not to mention U.S. cities, while the rich keep getting richer.
More American banks are in danger of collapsing, even after receiving aid from the federal government. The economy has done little to improve the financial conditions of many struggling institutions. An analysis of government data by the Wall Street Journal suggests 98 bailed-out banks are again on the verge of collapse. It means the number of troubled financial institutions have increased by 15% only during the summer. Altogether, the banks had received $4.2 billion under the government's Troubled Asset Relief Program in the heat of the financial crisis. 7 of the bailed-out banks have already collapsed, costing taxpayers a loss of $2.7 billion. The debt crisis is also threatening to spark a municipal meltdown. Research analyst Meredith Whitney says more than 100 American cities could go bankrupt in 2011. Among them are Detroit and San Francisco, and states like Illinois, Florida, and Arizona. American cities and states in total have debts as much as $2 trillion as they spend billions more than what they had collected in taxes. Many cities are struggling to even pay for providers of basic services such as street cleaning. The financial crisis has also deepened the gap between poor and rich to unprecedented levels. A study by think tank Economic Policy Institute says the richest American households have 225 times as much money as the average families. The gap is the largest since the survey began some 5 decades ago. Although most Americans hold the former Bush administration responsible for their economic troubles, many also put the blame on the Obama government for not doing enough to get the economy back on track. With both parties blaming each other for the country's economic woes, the big question for most Americans is whether the White House and Capitol Hill can work together to stimulate the economy.
Some astounding figures there. Let's try to make some sense out of it. Financial journalist Max Keiser joins us from Paris, and we have investigative journalist Wayne Madsen joining us from Washington. Thank you both for joining us. Let me start off with Wayne Madsen. You have troubled banks, and then the rescue comes in the form of TARP or the bailouts, and then these banks are now facing bankruptcy again. Why hasn't the bailout worked?
Well, I think it's a mere fact that President Obama surrounded himself in his administration. All these economic advisors came out mostly from Goldman Sachs. This is one of the companies that's responsible for this economic meltdown. So he's getting his advice from people who are part of the problem, and not people who could solve this problem. We have a President Obama who should be doing what Franklin Roosevelt did and using the bully pulpit of the White House, not to have little teas and luncheons with CEOs, but to be giving them orders. He's the President of the United States, and he's basically allowing the Wall Street fat cats to dictate the policy, and the policy, we see how it's working out. Today, we're told that 50 million Americans, up 10 million, are now without health insurance. What was that Obamacare all about? All that was something crafted by the Wall Street, the insurance companies on Wall Street, the big pharma, the big HMOs, and this is what we're left with, more people uninsured because, again, that policy was crafted by people who are very close to these Wall Street barons and tycoons.
Max Keiser, same question to you.
Well, I think if you take a step back and look at the big picture here, you have to understand that the American economic and monetary policies are structured in a way where the chairman of the Federal Reserve Bank is looking at asset prices and trying to stimulate asset prices, and as opposed to looking at jobs and trying to stimulate jobs. So all he looks at are those house prices. He's trying to get those house prices up by flooding the economy with more money. but every time he floods the economy with more money, more debt actually, the banks turn around and they say, oh, we just discovered another $1 or $2 trillion in bad debt that we had kept off our balance sheet, and therefore that money just ends up circulating on Wall Street, making a lot of people on Wall Street a lot of money. Now, during this period of time, the Fed's balance sheet has expanded by many trillions of dollars and is set to expand by many more trillions of dollars as this catastrophe continues to unfold. But at its core, at its root, is the fundamental question of whether the policymakers in Washington are there to promote and help asset prices or whether they're there to promote jobs. And they've decided to promote asset prices, and specifically houses, and to sacrifice jobs. And when you sacrifice jobs, you sacrifice savings, you sacrifice capital formation, and you sacrifice much of what has held the economy together for a long, long time. So they basically are sacrificing the economy, trying to stimulate the housing market and the speculation in the housing market.
Well, one of the ways that jobs do get created is what the U.S. Treasury Secretary Timothy Geithner said, Wayne Madsen, and this is in regards to the banks, that the bank bailouts will bring capital back into the financial system so that banks could lend again. But then the stats come out that the U.S. bank lending has fallen at the fastest rate in history. So what are the banks doing with the money?
Well, that's a good question, and I know Max has been on this for as long as I've heard him, the financial terrorists on Wall Street. You know, they're saying, small businesses. We're told small businesses create most of the jobs, but we hear that small businesses can't get the credit from the banks to even think about creating more jobs, employing more people, new startups. So all this is, in my opinion, it's some sort of weird alchemy that's going on Wall Street where they're trying to create something, but we see nothing. We don't see jobs being created. I know I spoke to somebody in northern Alabama yesterday. Unemployment there is at 33%. It's so bad. Young people graduating from high school have no other choice but to join the military. Well, that's pretty good for the Pentagon and its recruiting numbers. It also creates more cannon fodder for these senseless wars the United States is engaged in overseas, but it does nothing to create jobs. And I remember President Obama was in India. He said, exporting jobs to India will create more jobs in the United States. I don't know what planet this guy is from, but that's not creating more jobs. That's exporting mostly white-collar, high-tech jobs to places like India, and we see this across the board with this administration's policy, which is more concerned about the interests of Wall Street than the interests of Main Street. And we see what's happening to Main Street. We know that I talked to a top consultant to the Democratic Party, and he threw his hands up, said, no, there's going to be, he verified there's going to be city after city, county after county, and state after state declaring bankruptcy. Their bonds are going to be junk rated, and what we're going to see is what's happening in Europe now with Greece and Ireland and Spain and France and other countries happening right here in the United States, state by state and city by city.
Max Keiser, why is that happening? Why is it that there's these municipal defaults that are leading to over 100 cities, at the last count, facing possible bankruptcy next year?
Let me just go back for a second. Again, talking about the Geithner comment that he's trying to create jobs. And, of course, the Treasury and the Fed created quantitative easing 1 and quantitative easing 2. The latest round of quantitative easing putting something like $650 billion into the economy. But this money goes into the banks, and the reason it doesn't go into the general economy is because the banks at the same time suddenly disclose that we have another $1 trillion in bad debts tied to the real estate market. And by the way, they can't get the real estate market going because they're embroiled in a massive foreclosure fraud where banks sold, like Bank of America, sold trillions of dollars worth of fraudulent mortgages throughout the system, which is yet another layer of debt. So this colossal debt monster keeps unfolding, and it gets larger and larger. And to get to your question about municipalities and states, they're simply just going bankrupt because the people have lost their jobs. There's no tax base, and they're shrinking. And also, if you look at some of the investigative reporting that's been done by folks like Matt Taibbi over there at Rolling Stone, he did a fantastic report last year about how the banks on Wall Street, like the Goldman Sachs and the JP Morgans, have gone into these municipalities, constructed debt for equity swaps, destroyed their local economies, left them with 10 times more debt than they had to begin with, and then left town, leaving these poor counties on the hook for all this debt just to create fees for the banks on Wall Street, who, by the way, are going to be enjoying record bonuses again this year, more than $140 billion, record bonuses in the face of the 50 million people now don't have health insurance and the record poverty rates and all the rest of it in the U.S. That shows that the U.S. is really sliding down to a second world, third world status.
Let me bring in Dr. Roger Van Hanwehr from New York. He's the managing director of Arcxeon International to get another angle to this. Dr. Van Hanwehr, we talked about the banks, the possibility of them facing bankruptcy again. These are the troubled banks. And we talked about the cities facing bankruptcy also. Now, doesn't this mean that it's defaulting on loans? And if it does, then where was the oversight? I mean, loans were given. Shouldn't there have been a careful look at their, well, to start off with their ledgers to see what the payables and receivables were, what their assets were? Where did the oversight come in?
Well, certainly from the standpoint of recent loans, the bank failures are only partially due to those. Many of those are reprocessed loans in regional areas of the U.S. where there's great economic weakness, and the underlying reasons why loans default, which include unemployment, lack of monetary velocity in the economy, and just an inadequate level of infusion of capital into the circulating consumer exchange elements of the economy at the bottom tier. Those loans will always be bad in those regions. There's a massive dumping of foreclosures on the market. Home prices are plummeting for the fourth month in a row, and thus these loans essentially cannot be improved upon. And these were loans that were not in the worst class, or not considered to be in the worst class of loan statures during the 2008 crisis. So these loans essentially cannot be absorbed by the system. But the underlying weakness of the banks is that the monetary infusion that the Fed undertook to bolster the major banks in New York, Chicago, San Francisco, and elsewhere did not trickle down to the smaller banks. You asked the question earlier, what happened to all this infusion of capital? And the answer is it seeks maximum returns. So one of the reasons we have low monetary velocity in the U.S. is that much of the infused capital makes its way into bubbles on foreign markets in emerging economies. It leaves the United States rather rapidly. With respect to industry, with respect to hedge funds, with respect to other concentrations of capital, endowments, and so on, they are hoarding capital. They are unwinding positions on Wall Street, and they are essentially maintaining their reserves either in cash, in gold, or in fixed assets such as real estate. So one of the reasons that you see these problems with the medium and small tier banks is the infusion of capital from the bailouts is not making its way down to the fundamental bottom tier of the consumer economy.
Max Keiser, do you agree with that? And can you expand on that further if you can? Because some of it, obviously, we want to break down into just a common way of application, such as why from the bigger banks it's not trickling down to the smaller banks.
Sure. I mean, I would also add another major component is the level of fraud in the system. In this area, the foreclosure fraud that's enveloping banks like Bank of America, that's currently being investigated and subject of a lawsuit. This is trillions of dollars worth of paper that they fraudulently wrote, and this, of course, is not helping supply the velocity of money that's being mentioned when you've got the major banks embroiled in major lawsuits tied to their fraud in perpetrating this massive misrepresentation of their balance sheets and their to the regulators. In other words, every quarter, as we now know from what's happening with the investigation into Lehman Brothers, this is a problem that's systemic throughout the entire banking system. When it's time to report liabilities at the end of the quarter, banks reciprocate by hiding liabilities on each other's balance sheets for 2 or 3 days to avoid scrutiny by the regulators. They call it a Repo 105 is a one name for it. I call it peekaboo accounting. It's another way banks commit fraud, the biggest banks on Wall Street. And until, of course, these bankers are prosecuted and put in jail, as we saw during the S&L crisis, where more than 1,500 of them went to jail, they will continue to prey on the economy, and they'll continue to destroy the economy as part of their need to pay themselves bonuses tied to what is essentially fraudulent behavior. They're committing fraud.
Okay, let me get Wayne Madsen in for an explanation on the widening gap between the rich and poor. I mean, this UN statistic, a whopping 40% of the richest country in the world actually owning less than 1% collectively of the nation's wealth. How do you explain that?
Well, I think it's all part of the steady drift of the United States into a corporate fascist type society. We've seen this play out in history before, where only a very small elite has most of the wealth. I would also point out that there's another 600-pound gorilla out there, according to this Democratic Party economic advisor I spoke to. The commercial real estate market, when it collapses, it's going to compound the problem. Right, a block from where I'm sitting, you've got a building that was once worth $60 million is now valued at $30 million. So we're going to see when we see the commercial real estate market collapse, it's going to make the residential real estate market pale in comparison with that collapse. And this problem is just going to keep compounding. And instead of the president calling for a Roosevelt-type New Deal, he's offering the American people nothing more than a raw deal, which is going to increase the gap between the very small elite that has all the money and the shrinking middle class. The middle class, I'm afraid, in the United States is not going to exist in another 5 years, and everybody's going to be driven down to the lower poorer class, and they're going to be working, as many people, maybe 2 or 3 minimum wage jobs just to feed their families.
But wasn't it the lower class, Dr. von Hanwehr, that was part of the reason why the economy is collapsing, and that's due to these people who defaulted on their home loans?
Well, it's not as simple as only the element of loans, although home loans were a reflection of the underlying macroeconomic weakness of the U.S. picture. Certainly what you can see are corporations, again, showing profitability across the board as they move jobs overseas, as they move industrial capacity and infrastructure overseas, because the growth of the middle class in Asia by 2015 will equal that of the middle class in North America and Europe, that is to say the total size of the middle class. When you couple that to India and Brazil, much of the buying power at the consumer level is rapidly moving offshore. And we're talking now about manufacturing capabilities that don't relate to toys or clothes, but that relate to semiconductors and heavy machinery. We're talking a major relocation of U.S. industrial and technological know-how into rapidly growing, bubble-prone economies around the world where the buying power will be located. Essentially, the U.S. economy is being marginalized and no wealth is being created. That's the other element of the low monetary velocity equation.
Max Keiser, January 2010, there was an interview with the U.S. Treasury Secretary Geithner. He said the expected cost of the crisis was $200 billion lower than what they had anticipated. And he said that now this money can be used to meet U.S.'s economic challenges. Okay, fine. But now we have this, for example, a ratification of an $84 billion nuclear renovation or upgrade that taxpayers have to pay. What does that say about priorities?
Well, first of all, Geithner's comments, you have to understand that he's using the prism of his accounting methodology, which is corrupt. You can't really take anything that Geithner says on board as being representative of anything meaningful or truthful. And to get back to a point that was just made about the rise of the middle class in Asia, and of course this middle class is going to continue to put pressure on demand for things like oil, which means that the U.S. consumer, the middle class, is going to be squeezed again because the oil prices will go up in this stagflationary environment of rising oil prices while wages are stagnating or going lower. So this is putting the U.S. citizen into even a greater bind. But to finish off on Geithner, he's fronting for Wall Street. He's not in the service of the U.S. population. He's not representative of the U.S. population in any way. Geithner and Bernanke are representatives of Wall Street. They do Wall Street's bidding. There's nothing we should hear from him or the statistics that come out of Washington to interpret that in any way but, again, just massive fraud. This is a situation that is hard to imagine how it will be rectified without a major civil unrest, social unrest in the U.S. I'll put it that way.
Well, Wayne Madsen, we've talked about banks defaulting, cities in the United States facing a possible bankruptcy. We talked about the gap between the rich and the poor widening. What options are left for the U.S. president?
Well, what I'd like to see Obama do, I don't think he's going to do. There's talk that he may, in the beginning of the year, change a lot of people in the administration. We may see some changes in the White House, but it's clear that he should dump Geithner. Actually, the types of people he should be surrounding himself with are people like former Labor Secretary under Bill Clinton, Robert Reich, who has some different ideas about what to do altogether, but it may not be what Wall Street wants to hear. But I think he's got to really fundamentally change the people who are around him. Getting rid of Larry Summers and bringing in maybe Gene Sperling. I mean, what does that do? That's just the same types of people we've seen before shilling for the special interests on Wall Street. I would note that in the recent movie Wall Street 2, Gordon Gekko, who was the villain in the original Wall Street, he's let out of jail and he's doing speeches before campuses, and he says, they put me away originally for what is perfectly legal today. And I think that points to the regulatory problems. The Securities and Exchange Commission has not provided oversight. We didn't see anything out of Fannie Mae or Freddie Mac. Their internal audit mechanisms were non-existent pretty much. And so we've seen no regulation from the regulators, because the regulators have turned into nothing more than yes men and yes women for Wall Street. Okay,
and Dr. Roger von Hanwehr, same question to you, briefly if you can. What options are left for the U.S. president and his team?
Back to what works. Franklin Delano Roosevelt, public works. Rather than infusing cash into the major banks and into the interbank system, let's infuse cash directly into the pockets of average Americans. Start a jobs program for rebuilding U.S. infrastructure, just like Roosevelt did. Bring wage returns and revenue income directly into the pockets of Americans. Tie it to housing. Improve the grassroots of the consumer economy at the core functional level. Put the money where the greatest misery is, so that the psychological element of this recession is reversed. That's critical. Much of this is psychological as well. Reinfuse the credit capabilities at the small bank level, not at the large bank level, and do that through regulatory federal mechanisms. Force it. Don't allow the infusion of bailout capital or printing new monetary loads of dollars that immediately float to other markets across the world.
I'm sorry, I have to jump in here. We've unfortunately ran out of time. I apologize for that. Dr. Roger von Hanwehr from New York, Managing Director of Arcxeon International. I also want to thank financial journalist Max Keiser from Paris, and also investigative journalist Wayne Madsen from Washington, and you, the viewer, for watching. Thank you so much. I'm Kaveh Tagwe from the entire team. It's goodbye.